Hello and welcome to this webinar presented by Affinity and Dealroom. My name is Paul Ross. I'm VP of Marketing at Affinity. And what we're going to be focusing on today is some data that both of our companies have been producing around what's been happening in terms of the emergence of more and more unicorns, specifically in the European market, and how data can really play a strong role in helping venture capitalists, private equity investors, whoever it is, to really identify who's going to be the next one of those companies to make that billion-dollar valuation. If we look back at throughout Europe, we've seen about 381 startups from over 65 cities pass $1 billion in terms of valuation. But the other thing that we'll see, and we'll discuss this in a lot of detail today, is that it's become much more competitive in terms of identifying, finding, and getting involved in those rounds. That is really a challenge for many investors on a global basis, not just those in Europe. So what we're going to be doing is we'll review some of the data that we've gathered. We'll look at some trends, and then we'll discuss what kind of impact that might be having to the deal makers who are on the VC and PE side overall. I'm joined today by a couple of real experts in these markets and how data is specifically used. Orla, I'd love to have you introduce yourself and Dealroom if you could.
Yeah, sure. Hi, nice to be here. I'm Orla Brown. I'm head of content at Dealroom, leading the intelligence unit that works on our research and insights. Dealroom is a data platform providing data and insights on startups and venture capital globally. We're based out of Amsterdam with a global team and global coverage.
Awesome. Thanks so much for joining us today, Orla. Andy, would you like to introduce yourself as well?
Yeah, I'm Andy Bryson. I'm the SVP of product. Here I oversee the product management, data, and partnership functions, helping us expand our coverage across the globe.
Awesome, excellent. Well, thank you again, both of you, for joining us. Let's get into some of the data we pulled up. So I think we actually just recently put out a report around the kind of state of unicorns globally. And one of the key things that we clearly saw in 2021 was that valuations were going, quite frankly, insane in terms of where the top unicorns were ending up. A lot of this is clearly somewhat in question in terms of whether that trend is going to continue because of the kind of change in multiples that have been seen in Q1. But I think that this is a real indication of the continuing value of SaaS products on a global basis. There's a variety of different industries being served by what we're seeing here. So I think it's a wider group, but also like the valuations of them specifically have gone up. One of the most interesting trends that we were seeing in the data that we were looking at was that if you look back into 2017, about 60% of the top 20 unicorns were founded in the US and only 10% in the UK. And then there was kind of a degrading number after that, with India being a kind of similar number to the UK. But now if we look in 2021, the top 20 look quite different. So the US remained on top clearly with about 43%, but the UK now had 19%, almost 20% actually, and Germany coming through, Austria, France, much more a wider set of geographies being represented here. Orla, maybe if I come to you first, I'd love to get your thoughts on what you're seeing in terms of the emergence of a much broader set of countries delivering on high investment and unicorn states for startups.
Yeah, totally. I think that what's really emerged as clear and obvious in the last couple of years is that unicorns can be built anywhere, and they are being built anywhere. I think it's also a reason why data is so important. If we think about how investing used to be done, it was often very network based. It was, the conversations you'd have in a coffee shop or people you'd bump into at a meetup in the valley. And now really companies can be built anywhere, unicorns can be built anywhere. As you said, 65 cities in Europe alone that have produced at least one unicorn. And that means that investors need access to the data in order to be able to find these kind of companies. People are seeing companies like UiPath come out of Romania or Getir in Turkey and are thinking, wait, we don't want to miss the next one of these. So it's really going global, not just pan-European, but global. And yeah, I think it's really exciting to see. The other thing is that as some of these ecosystems emerge, we start seeing a snowball effect happen. That's why you see the 10% to 20% for the UK. UK kind of 10 years ago was a bit of a joke in terms of in terms of startups and investment, but in terms of the international kind of opinion. And now really it's a top 3 global hub for investment and for producing unicorns, past $1 trillion in combined valuation of startups and tech companies a couple of weeks ago. Yeah, firmly on the map now.
Definitely. Andy, one of the things that's interesting here is like, as a software provider to this industry, what have you seen in terms of the changes in this landscape of where things are happening, especially if you think about it in the context of the types of investors that we have working internationally? If you look at it from a US perspective, there's obviously the VCs that are in those countries, but we also see a lot of US funds setting up European operations. How does that impact how you think about the product that we offer and the data that we provide to them?
I think that's exactly right. What we've seen is that the traditionally strong U.S. funds have started to create a presence in Europe and try to take advantage of those emerging markets that are sort of new and exciting and they will be present in. And so we see that the customers will have multiple offices and try to ensure that they can leverage each other's networks and stay on top of essentially what's happening in each of these markets. So that's happening at the same time we're seeing more and more of these sort of new funds and new investors opening shop in each of these markets. And so there's this real competition right now to identify those early stage startups that can become the next unicorn. And the competition is both between sort of the firms that have been around for a long time and a lot of new emerging firms, creating sort of much more competition to figure out who they should be talking to, what funds or what companies they should be investing in. So it's an exciting time, certainly as a supplier.
Absolutely, yeah.
I think it has a knock-on effect as well for the European funds as well. So, I mean, I think there might be a feeling of the Americans are coming up, setting up shop in London or Berlin, but the funds in Europe that have been around for a while, they're raising bigger and bigger funds themselves. So there's a lot of dry powder out there in Europe from domestic funds as well as international.
Yeah, well, I think we'll get into some of that, the diversity of where that capital is coming from in a moment as well, but it's definitely a changing landscape for sure. Orla, one of the key things that Dealroom provided as we were looking through this is the sheer size of, or the sheer amount of capital that's been deployed. This is 2021 again, second half especially was a banner year. Do you kind of see that continuing, or is there any slowdown that you're seeing in terms of the investment from a European perspective right now?
Yeah, so of course 2021 was a kind of bananas year globally for investment. VC investment doubled in 2021 compared to over 2020, but it grew faster in Europe than the kind of global average. Whether we're going to see a bit of a slowdown in 2022, I think that's something that a lot of people are talking about. At the moment, the pace is kind of keeping up, I would say, although fair to remember that those are kind of deals that will have been in the pipeline for a fair while. But the fact that European investment has been kind of outstripping the rest of the world for a while, I think is already a kind of strong sign for future growth as well.
Got it. Yeah, and you mentioned earlier the kind of the sheer variety of places that unicorns are starting to come from in terms of the European landscape in general. But clearly in London, you're seeing there's a lot more there. What's changing and what's kind of like the new areas of success you're seeing? I've personally seen like Paris especially be a place that's not been on the landscape until relatively recently in terms of where some of these really successful startups are coming from. What's your perspective on that?
Yeah, so I think obviously London is a massive and important hub, but it shouldn't mean that people overlook the rest of the continent. I mean, if you look here, in the UK alone, there are 5 other cities with more than 1 unicorn. Like Oxford, Cambridge, Manchester, Edinburgh. But yeah, these unicorns and other kind of fast rising startups are emerging all over the continent. And I think there's some really interesting ecosystems that are quite distinct within Europe as well. We looked at Central and Eastern Europe recently, for example, and there, the countries like Poland and Estonia, Romania producing some really interesting companies, but 30% of their unicorns that produced in Central and Eastern Europe have been bootstrapped, which is a massive proportion. Like the European average is 7%. So to me, that also says, you know, well, maybe the entrepreneurs in these countries are, you know, able to generate revenue very fast, but I think mostly it's put out of necessity. It's because there hasn't been a huge amount of capital going in there, and not a huge amount of attention. I think that's starting to change with some of these big names that are coming out, and people start taking a bit more notice. But yeah, there's still a huge amount of untapped potential, but right across the continent.
That Eastern European stuff's really interesting, as you're saying, in terms of like whether it's an access to capital issue or not. Andy, when you look at this kind of graphic here and you see the distribution, how does this kind of make you think, or what does this make you think of in terms of how we provide data to help people find these types of potential, you know, investments? You heard what Orly just said in terms of maybe there's an issue in terms of access to capital in some of these places, but there's a lot of different countries here, a lot of different kind of specific ecosystems. How do we think about that from gathering the data that might actually help people get to those accounts, those firms, excuse me?
From an investor perspective, I think it's access to information, right? And so it's really difficult to be sitting in London, for example, and have visibility into who the serial entrepreneurs are in Eastern Europe, or who the companies are that have sort of recently raised a seed round that have real potential. And so I think it's really understanding how to get access and insight into those data sets early, be able to turn them into sort of key parts of workflows for the investors, so they really can get visibility into that, take action, follow up, understand how to build the networks within those regions, so that they can leverage those networks to then get more information that isn't available in any sort of public data set or specialized data provider. So I think it's really kind of leveraging both the networks and the data sets.
It's a lot more reinforcing as well. Yeah, I get what you're saying. Well, one of the other things that's interesting here is this is something that Orly, you kind of highlighted earlier, was this kind of greater diversity of where investment's coming from. You know, clearly private equity has been a big area for European investment for many years, and probably in terms of percentage, I think outstrips the US, historically at least, versus venture capital. And then there's an increasing number of crossover funds and family offices and other areas of kind of non-traditional investment. What's your perspective on what this looks like? Because to me, this looks like much more competition for traditional VC more than anything else.
Exactly, yeah. So I think that when people talk about competition in VC, they're often thinking about other funds, and actually there are a lot of other actors who are getting interested, as you say, private equity, crossover funds, family office allocations, institutional investors that are, you know, have seen successes of, you know, the entire NASDAQ, and are thinking, well, we want to get involved in some of these companies a little bit earlier. And that has some kind of cascading effects as well. So if you've got kind of late stage or institutional money coming into the private market, the late stage investors start having to look earlier. That has a knock-on effect for the mid-stage investors. And so what we see is that investors are increasingly looking for companies right from their inception or even before. So at the moment, we're, for example, building out our data set on university spinouts, because early stage investors actually want to find those companies, in inverted commas, before they're a company, when there's just an innovation on a campus. So yeah, the competition it means that there's a push towards investing ever earlier.
I think one of the other parts that's interesting here, Andy, I'll come to you in a second, was just the fact that there's, you were talking about like the earlier stages, and then there's like people who have like much broader types of investments as well, where they're investing across the whole spectrum of stages. Great example here. Andy, what's your perspective on that competition, and even if you think about like what are almost in our world called alternative investors like Tiger and all of these other guys? What's your perspective on this rise of competition and what it means from a data perspective?
Well, I think there's a lot of macroeconomic factors here too. What we've seen is that through the pandemic and over the last few years, that there's been these outstanding returns on some of these exits, especially as some of the central banks have sort of pumped up the equities, and that's driven up really the valuations. And so if you look at, you know, what will likely drive those valuations is sort of forward-looking multipliers. and they're very, very outsized right now. And so that's creating fantastic returns to these funds. And I think the fund's success have driven interest and intrigue from other alternative investors, whether that's family offices or even corporates, which are sitting on large tranches of cash that they need to figure out what to do with. And so I think that's sort of traditional venture success has driven a lot of interest from all sorts of different new players into the space. And we're seeing that as we get customers sort of knock on the door to say, we'd like to go open a fund, whether it's through family office money or whether it's through LP raising. But we're just seeing more and more players come into the space. And those players are investing across the spectrum, as you said, Orla. Like, so you'll see some seed stage investor funds that are coming out of traditionally late stage players. So there's just sort of more and more interest across the range.
Yeah, we're definitely got a theme for. Go ahead. Sorry, go ahead, Orla.
Yeah, and coming from different industries as well. I think if you go back to that slide, it's such a nice example because Bernard Arnault, who briefly became richest man in the world last year, he's had some punchy things to say about tech in the past. He said, you know, the only place you get luxury margins is in luxury goods, or I don't know if the iPhone will be around in 20 years, but people will still be drinking. Whereas if you actually look at his kind of portfolio, his family office invested in Netflix's Series D in 1999, had late-stage investments in Spotify, Airbnb. His family office and LVMH have been the L and L Catterton private equity since 2016, which have backed companies like Kazoo. They then launched Algea Ventures, which is an early-stage VC fund backing early-stage French startups. And we're already seeing that actually these different instruments are backing the same companies just at the right stage. So Back Market was, Algea Ventures was a first check investor in Back Market, which was then, they later followed on through the family office. And then even up to kind of acquisition where they acquired List at some point as well. So I think that yeah, it's not just tech that's investing in tech. It's a lot of different industries that are starting to take interest as well.
It's interesting, Andy. We had one of our clients, Bain Capital, on a similar discussion to this recently, talk about within Bain Capital, obviously they have almost a similar set of different types of funds or capital sources and approaches that they're taking, and that there's much more sharing of information going across those groups within Bain Capital because they are doing the investment at the very earliest stage. They do have a private equity arm. What's your perspective on like how that sharing of information and things can work most effectively here? Like, what's the thing that is actually going to help them be able to deal with more competition, but having more ways of actually investing funds?
Yeah, I think what we've seen is that the investors have specialized skills and focuses, and so on the venture side, they may be a specialist in a specific area of investment in the networks associated with them. But across the firm, what they're really trying to do is understand their broader portfolio. Where are they making investments, or where are they in late due diligence for specific firms, and then sharing a combination of sort of the broader portfolio, through before investment, and the networks associated with those portfolios and prospects. And so what we're seeing is that whether it's a PE side or which might have some growth equity components, or the venture side, they're really trying to leverage the broader organization's network of sort of who they know at the various companies in order to make sure that they get an opportunity to have that conversation with those founders and potentially make that investment.
Yeah, we're definitely seeing the competition take play out here, and maybe we just briefly touch on this. We kind of talked about corporate investment going up as well, and Orla, you kind of highlighted this as a key thing, especially in the last year or so. But this just adds to the competition of where capital's coming from for startups, I think.
Yeah, exactly. I don't know if you follow the meme account Praying for Exits, but last week there was a kind of call for what's the most random corporate venture arm out there, and people were submitting, fertilizer companies and cement companies, and that, like, any industry now, any corporate worth their salt is launching a venture arm. So it's getting increasingly competitive out there.
Well, it's that or buy a load of crypto.
Yeah, the news was that corporates had $2.5 trillion in profits in the last year. And so they're sitting on that and figuring out what to do with it.
Yeah.
And instead of stock buyback, they can go invest in new companies that have strategic value.
Yeah, it's definitely a key road. And I think overall, we're just seeing more funds. You said this is really important, a really important point earlier, Orla, which was, hey, we're seeing all of this capital deployment. We've seen all of these huge rounds, and it's just constantly happening. Seeing $500 million rounds on a regular basis in terms of pretty frequently. But there's a lot of dry capital out there as well, like dry powder, excuse me, in terms of capital there. Like, this is going to be an interesting year for how this gets deployed and how we deal with it.
Exactly. So this is just the number of new funds raised by VCs last year. If you actually look at 2022, it's outpacing 21 in terms of the capital being raised by VCs. So yeah, this money is going to have to get spent somehow. So we might be thinking of people retrenching. Maybe they're going to be looking at valuations and multiples a little more carefully. But yeah, there's a lot of dry powder ready to be deployed.
Yeah, it's going to be interesting. We're going to be watching the number of deals getting kind of deployed or started and managed within our platform pretty tightly here in Q1. It's going to be interesting to see how that went. And because I think, Andy, this is one of the interesting things is that if we kind of turn this now into how does this operate, all of this operationally affect investors and GPs and the associates in these firms on the VC side or their equivalents across these other funds, we saw just this massive increase in the number of deals that people are actually having to manage. I think that points towards a lot more.
That's right. I expect even more. The combination of the significant increase in new funds and sort of capital available, plus some pressure potentially on valuations, means just more investments required in order to actually deploy those funds. And so, combination of all that plus competition means you're just spending a lot more time as an investor or an associate, sort of working through who do we talk to, going through the due diligence and figuring out the valuation process. So
that's an interesting perspective that you see it driving it up, because I think there's been a lot of conversation about the volume of deals decreasing maybe, and because terms are changing. I saw an interesting piece the other day around the potential end of the one-day close with all of a sudden different liquidation terms coming into offers. But you're raising an interesting point there, which is like that might not actually lead to fewer deals being managed. It might change the number that are closing, but it's not going to change the actual number, or it may even not slow down the number of deals that people are actually involved in.
Yeah, I think that it's quite possible that the deal volume goes up, both across the industry. I would expect so, just because of the additional capital,
right?
But also in competition, right? Everybody wants to get in on that really exciting new company or company that's scaling quickly, and so you'll have more participants in that process, I suppose, for a given company. But I just think in general, you need more deals again and again across the industry.
Interesting. I guess we're now getting into much more kind of operational thoughts of like, how do people actually deal with this challenge that you've both described of going up these, and like, let's be clear, this is not a negative situation. This is a incredible time to be in venture, incredible time to be in any type of investing, because the opportunities for great companies are out there and all these things. But what we're really describing is there's so much more effort required, so much more things to be managed. Andy, maybe if I can start with you on this next topic, is like, how do you kind of talked about this earlier about like, what's the impact of, or the opportunity for people to get ahead of these competitive pressures, specifically thinking about our world of relationship intelligence? Like, what's the key in terms of managing that on an ongoing basis?
I think the VC of old really spent time in coffee shops getting to know people, and through the pandemic, sort of the global expansion, we're seeing that that's changing a lot. And so what's happening now is there's a lot more focus on sort of outreach and more digital interactions with founders and serial entrepreneurs to build that network. And I think, as this data suggests, that it's not really about building new contacts in the last year. It's about leveraging the ones that you have to identify that next opportunity, and those existing contacts are actually driving an increase in deal flow and more meetings. And the meetings are because they can be virtual, and so you can, investors and associates can spend time with more of those entrepreneurs, sort of over whatever video format they want, Zoom, GoToMeeting, whatever that is, throughout the week. And so that's increasing the number of conversations that are happening in the deal flow, all mostly leveraged from existing contacts in the network.
Interesting. Yeah. Orla, this is data from our platform that we kind of look at, on a fairly regular cadence in terms of understanding what the activity levels are in VC. We've got almost like 1,800 venture capital or private capital people using our firms using our platform, so we get a lot of data like this. But I'd love to hear your perspective on this. If you think about this, this is top of funnel starting point for deals. How does the deal room data kind of fit into making this an easier thing for people to deal with? Because you're like looking at all these hundreds upon hundreds of meetings that people are dealing with. How do they kind of use deal room data to actually get to oh yeah, I should be spending time with this person?
Yeah, for sure. So we work with kind of all of the top tier VCs, and they use deal room data for discovery. And I think that it's definitely true that the pandemic has forced a change for VCs of where they now look a little bit more broadly about who they're maybe targeting. Deal room is a good example in itself. Actually, we raised a round at the end of last year. We're headquartered in Amsterdam. The round was led by a London-based investor, and we never met until after the deal was done, even though it's normally just a train ride away. But it wasn't possible to travel at the time. But I think that's a trend that's going to stay for sure. Investors are seeing, actually, I don't need to meet somebody in person necessarily. I don't need to do really long, arduous trips. I can do this virtually, and that goes the same for the companies as well. So startups are able to be based anywhere. They don't feel the need to move to Berlin, to London. They can hire talent that increasingly wants to be have more flexibility. So there's a distribution of the startups as well as the deals that's kind of been accelerated by the pandemic. That's not to say that tech hubs aren't important. Of course they are. Having people in the same place, you get serendipitous transfer of ideas and things like that. But it's not the default or the only way of doing things anymore. And I think that most people have been convinced of that in the last 2 years.
Yeah,
investors are no longer investing only in the backyard, right? Because the whole, if you're doing it virtually and digitally, you kind of have the world available. And so we're seeing people definitely reach out farther beyond what they're used to or historically have done when considering where to invest.
How do you think about that in terms of the data sets that you provide in Affinity or a deal room? Is there anything that changes how you have to think about like what data you're actually pulling together?
Well, I think from Affinity's perspective, there was very much a Silicon Valley focus when we started. We partnered early on with VCs in the area, and so the data sets that sort of represented their traditional investments were most important. And as we see that many of these funds and customers are expanding beyond that area, we have to find new data sets for sort of the combination of startups and entrepreneurs and late stage companies in those new regions. And so that's a great reason why Deal Room is a fantastic partner. They're bringing better visibility into that information in Europe. We see the same thing in Southeast Asia and in Israel and Scandinavia. And so it's like each new market where people are looking requires us to sort of evaluate what data we either have or we need to go get to satisfy those customers.
Yeah, for sure. I'd say the same. I mean, I think that our clients as well are interested in companies that are promising no matter where they are. So it means that we need to find the data on them. And yeah, the easiest way to do that is working with people on the ground. So, we work with VCs and corporates, but we actually also work with governments. So we help them with measuring their startup ecosystems and so that they're able to find ways of supporting and accelerating their startup ecosystems. But by working with them, we're actually able to capture a lot of data and insights on what's happening in Poland or in Lithuania. So it means that by working with the governments, we're able to massively scale up our the quality and quantity of the data that we have on these other ecosystems, which can then be used by the investors and the corporates. So yeah, we're constantly trying to get data on startups no matter where they are.
That's an awesome kind of approach of working with those governments, because they're obviously, all of them are very keen to invest and want to see return, and so therefore willing to share their information. One of the other things that we saw is when we started to look at in our benchmark report around unicorns, looking at the funds who were investing in those top performing startups, there's some really marked differences in the level of activity within those accounts. And it might feel a little obvious to say, but it looks like these people are putting much more effort in. There's a lot more hustle happening. If you think about, like, each firm typically might have almost 25% bigger network than the average one, that if they're investing in these top level unicorns. It might be self-fulfilling, Andy, but what's your perspective on this?
I think these larger firms that have had historical success definitely do have traditionally larger networks. Success creates more interest in connecting and staying connected, and so those networks just continually grow, and that does kind of reinforce that idea that they have a larger network. But if you look at the activity, the number of emails sent, and sort of the deals and meetings, they're also larger. And so they're not just saying, well, because we have that brand recognition and associated network, we're going to just wait for those deals to come. They're working. They're going out and making sure that they're staying connected with those people, and finding those opportunities to go explore. In doing so, it's sort of at a higher clip than some of the competition. And so it's definitely not. It takes work. Is what this says.
Yeah.
Now.
Yeah, that's the key takeaway for me, is that they might have a bigger network because they're a bigger firm, but they're still doing more activity in there as well, which is an important part of it.
I think
the
it's
next part of it,
competition too, right? Even with the brand, there's still competition from others. It's not as easy as it once was.
Well, I think one of the key points related to that is that we were highlighting the difference in the type of competition that it was before. Like, if you were Andreessen, competing against Bessemer for an early stage thing in the past, now you're competing potentially with, a public investment entity that's bringing, the famous one-day close into play here. So you're having to compete in a different way, as well as with those ones previously. The other thing Andy, I'd love to hear from you, and then I'll turn to Orla, is how do you think data and things are playing a role in managing those deals going forward? Because I think we've talked a lot about kind of top of funnel, getting engaged, getting people going, but how do you think that this is playing out in terms of managing the deals through the entire process?
Yeah, I think what we're seeing is that more and more firms are using data in the qualifying stage. So there's sort of this idea of identifying some opportunity, but there's data that's helping them determine how far they bring it into the deal flow. So that could be things like employee growth count rates, or NPS ratings, or traffic, all these other signals that help them understand, is this company having sort of outsized success in an industry? And so what we see is that more and more firms are trying to incorporate that data early into the deal flow to determine effectively where they allocate their time as they're trying to move it across that funnel. And so there's requests for quite a bit more and varying data types,
right,
historically seen.
Yeah, it's funny. I previously worked in the kind of public market data world, and we used to call a lot of that kind of alternative data. I don't know if that really exists as a bifurcating term anymore. But Orla, it's just data now. Like, I think in terms of people's expectations. But Orla, how does that type of transition, or that type of new need, impacted what Dealroom provide in terms of their data sets? You talked about going after those government data sets and bringing that in, but is there other things that you're starting to see as requirements from your clients as they're looking at driving deal flow?
Yeah, so some common asks that we've been trying to implement recently. So there's the university spin-outs thing that I mentioned. Also, a lot of focus on diversity and impact, I would say. So we now categorize companies, impact companies, and map them against the different UN Sustainable Development Goals. We also have the kind of founder, some founder diversity data, trying to build that out as well, which is challenging. We've got kind of gender pretty good, but there's other areas of diversity where it's much more difficult to get the data, but is very high in demand. So yeah, I think that those are, as well as the kind of performance metrics that Andy was mentioning, you know, things like growth rates. There's a lot more focus on things like impact and diversity and ESG, those kind of questions coming through.
Yeah, we've seen that ourselves as well in terms of as you pointed out, there are a lot harder data sets to actually gather and get accurate as well is a big part of that. So making value, but huge demand overall. And I think that kind of flows into this as we close out here is how are we thinking about making this data more actionable for folks? I think you know, Andy, you talked about increasing, you know, headcount data, or and Orla, you talked about the kind of DEI or ESG type metrics. One of the key things we hear a lot from clients is that data is only useful if it's in the context of what they're doing on an ongoing basis. How do you guys think about delivering this type of data to investors in a way that's actually useful for them?
I think from the Affinity perspective, what we're seeing is that there are many, many different data providers out there that offer insights that help them with their investments. But what our customers are really looking for is for that to be put in the context of their normal workflows. So put into the applications or sort of the tools that they use on a daily basis, so that they can use that to make decisions without having to just constantly switch contexts or try to sort of process and digest data elsewhere and then bring it back. And so what we're seeing is, you know, give me context while I'm in a meeting, give me context while I'm looking at a website. And so the pressure is really to aggregate that data and then give it to them kind of where they're working. And I think that focus on taking data and tying it into those applications and workflows is sort of where we're feeling the pressure to continually innovate.
Yeah, I agree.
Well,
Yeah, I mean, I think the data is one thing, but being able to use it is another. And so making it easy to find and use, making it intuitive, and putting it in context as well, are such important things, which, yeah, we're constantly trying to do as a data platform, which I think is pretty intuitive and easy to use, but also with this partnership as well. So I think, yeah, those are the real differentiators, is changing data into insights and something that's actionable.
Well, and I think overall, this is just having worked in data and analytics for 20+ years. It's always going to be about how we put it into the context of what people are doing, and I think that workflow is what really matters. Whether it's at the prospecting level, filtering companies in and out, actually helping drive a deal forward with relationship intelligence or other things. It's so important that that's actually in the things that people do on a day-to-day basis. Awesome, guys. Well, we're coming up to the end of our time here. I really want to thank both of you for the insights and the really interesting conversation that we've had here. I think that it's pretty clear that we're all seeing the increasing competition. We're all seeing the importance of focusing in on targeting the right potential investments, but doing that in a way that's not going to kill people's productivity and kills people's ability to actually do their jobs on an ongoing basis. Competition is definitely a big part of that, but so is just the amount of capital that gets to be deployed over the next year or so. So I'm really excited to see how this next first half of 2022 goes in terms of continuing some of these trends, and we'll see if it makes it another banner year for investment, specifically in Europe. With that, I want to thank Andy and Orla. Thank you so much for your time today, and we'll conclude.
Cool, thanks,
Thank you.
man.
Thanks, guys.